Welcome to AFO Wealth Management Forward, a podcast powered by Arrowroot Family Office that's at the intersection of accounting, wealth management, behavioral finance, technology, and entrepreneurship. We help accounting firms and financial advisors grow their practice by going beyond the numbers as we learn from industry leaders and subject matter experts to discover the secret to their success. A podcast that highlights everything from the transformative power of AI to embracing the human-first approach of behavioral finance to help you understand the psychological and emotional relationships to money and meaning. Here is your host, Rory Henry, director at Arrowroot Family Office and author of Holistic Guide to Wealth Management.
All right. Hello, everyone. I have another great guest joining me today. He is the CEO and founder of FBO Strategies and creator of the trademarked Carbyne Allocation approach. We're here to talk about how life insurance fits into financial planning, retirement planning, and why this matters to advisors. So without further ado, let me introduce our guest and my friend, Keith Friedman. Keith, welcome to the show.
Thank you very much, Rory. I really appreciate you having me on.
Yes, I really liked our conversation because you were able to really talk about how we can fit life insurance into this holistic financial planning type of model here. So before we get into the blocking and tackling of how we do this and the advantages of using life insurance, why don't you give our audience a quick background on yourself and how you came into the world of insurance here?
Sure. So I actually started my career as a research analyst doing something called sovereign analysis on US and Latin America, which actually involved a lot of Fed rate watching. So I'm actually still pretty good at it. I can still.
Did you predict the rates?
I did. I got it right this time. I got
did.
the 25 basis points.
All right.
It was on my chart. I did not go for the 50 that a few people were talking about.
Yeah.
I didn't think the Fed's pretty good at like telegraphing this stuff these days. But I'm pretty good at still getting it. So after that, I rode the dot-com boom like a lot of people of my age group. And when it crashed, I went into financial advisory. We had a family friend who was in the business, is like, Keith, you know enough about the markets to do this. And I was like, okay. So I got licensed, I got securities licensed, then I got insurance licensed. And I was working at what was called a captive agency. They were part of MetLife, and then I went to a Guardian agency. And then eventually I went out on my own and I started my own firm, and I built it on a few principles because one, I wanted to be independent. I didn't want to be beholden to any company. Two, our approach is totally analytical. I have a hard time with all the sales strategies that are out there.
Yeah.
My wife would always say that, Keith, you're being too logical. I hear that a lot, actually, from her. And then lastly, we're going to be transparent. So we are completely transparent about our compensation. We do work in the commissionable product world, and being transparent about how much we're compensated actually helps to alleviate some of that conflict of interest that's out there. It doesn't eliminate it, but we are transparent about it. So, that's really how I got here today. I mean, there were some other big steps along the way, but, I can bore people with that at another time.
Well, let's kind of talk about alleviating some of those concerns, because there's a number of common misconceptions that CPAs and financial advisors have when it comes to life insurance and in general, permanent life insurance. Can you kind of talk about those misconceptions and how you can communicate ways in which we can think about this?
Sure. I mean, permanent life insurance or cash value life insurance is frequently viewed as something that's expensive. It has high fees in it. It's rigid, and also it doesn't perform. Now, some of those things are true. There are commissions in it, but over time, the commissions and fees in them are actually less than if you paid an advisor to manage your money. Okay. Policies are actually not rigid. If you know how to manipulate them, they're actually very flexible. They do not perform. This is the biggest misconception that people have about it. There was a quote on LinkedIn the other day that an advisor was evaluating a whole life policy and it only generated 3 to 5%. And and this is where our approach comes in, but 3 to 5% tax-free is a wonderful rate of return. And I would take that every day of the week and twice on Sunday. Now, there is a thing about life insurance and the way it's structured that it does take a little bit of time to become what
Yeah.
we call cash flow positive.
Yeah.
But that's very much like buying a house
Mm.
or buying a piece of real estate. You don't always have you have positive equity, but you might not have more than you put in, especially early on.
Yeah.
So, but the way we design policies, we are trying to get over that hurdle as quickly as possible. We design policies to have maximum cash value accumulation
Hmm.
because of the tax efficiencies that it applies. And is it expensive? It's only expensive in the way you buy in a house that's too expensive, that you don't have the assets to support it. So our approach is we have a defined allocation that we look to based on our clients' risk tolerances. It's
Hmm.
not, out of thin air, how much we put into it. And therefore, it's not expensive. It's not cheap. It's neither. It's just an asset they're going to own. And we have to recognize how it behaves and performs within their overall asset allocation.
Yeah. Well, let's talk about that overall asset allocation and how really the policy can do more than just providing a death benefit. And, it does provide peace of mind as well for families. Can you kind of talk about the other advantages here
Sure.
of,
So, first of all, purchasing life insurance as a whole for the death benefit is one of the soundest decisions they make. That could be term insurance, it could be
yeah.
permanent insurance. It actually creates great peace of mind. A friend of mine did a study that I'd be happy to share with anyone who's interested on how you actually sleep better when you have life insurance. All right. But the other thing is, it's a misconception that your money is not liquid to you while it's in there. Yes, there might be some surrender charges about putting it back into your
Yeah.
pocket, but if you have $100,000 of cash value in your policy, you have access to maybe 95 to
Yeah.
98,000 of that. All right. There might be a little bit of a hurdle getting it, but just like you take out a HELOC
HELOC.
to get money out of your house, it's actually much easier than getting a HELOC. And the other thing, and this is the big trend the past couple of years, is we also use life insurance as a hedge against long-term care.
Mm.
Clients can now access the death benefit of their policy early if they
Mm.
need long-term care. And this has been a big mover within our cohort and our clients and the other advisors we work with to hedge against that cost. It's actually, over the long term, a great way to almost self-fund it on a tax-efficient basis.
Yeah.
So
Can
that's
you kind of dive into those mechanics there on how folks are accessing the long-term care?
Sure.
For example?
The typical policy, let's just use a round number. Someone has a
Yeah.
$1 million death benefit. The carrier might give you 25% of that death benefit. It's
Hmm.
really 24 because they give you 2% a month, but
Hmm.
25 is some number, can understand. They'll give you 25% of that a year over 4 years. If you don't use it all in 1 year, you don't lose it. It just goes to the end. So a client has $1 million tax free to pay for long-term care.
Mm.
Maybe it's not a million, maybe it's 995,000 because there might be a little bit of a holdback and there still will be a residual death benefit. But when clients get to that point of needing care, they don't have to use it. They can choose to keep the death
Yeah.
benefit and fund long-term care a different way if they have significant assets, but it's a choice they have. It's complete flexibility. They're not forced to use it, and every client is different. So
Yeah.
we don't know at the moment they need care where their assets are going to be, what they're going to need. This is just an incredibly flexible tool. And
Yeah.
because we use products that are fixed, meaning whole life and indexed universal life, those products will be there. There's not the volatility that the markets bring
Yeah.
to other types of planning. And I don't get me wrong, I have nothing against investing in the markets or using variable life insurance products. It's just not what we do. We
Hmm.
are there to provide a stable, secure place for our clients' money to be parked. All right. And
Yeah.
I don't begrudge anybody who takes other approaches. But when we're talking about protecting our clients, we want that security.
Yeah. Well, speaking of security, I know you talk about, Harry Markowitz and, modern portfolio theory,
Yeah.
they developed back in the 50s. And the goal is really to get that client to that efficient frontier by reducing
Right.
risk and increasing returns. Can you kind of talk about how your Carbyne allocation really fits into, a portfolio and how it compares to, Harry Markowitz and Martin
Yeah,
Portfolio?
so I'm a big fan of Harry Markowitz, even though there is nothing modern about the modern portfolio theory. Um, but Harry's whole point was that you have to own different assets.
Yeah.
So what Carbyne does is that it reallocates your conservative assets, not your equities, just your conservative assets. So that's your
For
bonds,
example, yeah.
right? Your bonds, your bond funds,
Right.
CDs, maybe money market accounts, maybe those high yield savings account, and allocates them into a cash value life insurance that is designed specifically for cash value accumulation.
Yeah.
We are not designing it for death benefit. There are death benefit advantages to this strategy, and we can talk about that another time. That's a
Hmm.
whole different discussion. But we're doing it to take advantage of the tax efficiencies. So we're actually going to eliminate all those assets are incredibly tax inefficient. You get
Hmm.
a 1099, except maybe a bond ETF. You get a 1099 every year. So if
Yeah.
you're earning 5%, 30% tax break, you're really just earning 3.5%. If you earn 4.5% in your whole life policy, or maybe 6 in your IUL, you're really earning those amounts. You don't owe the government anything. So we are going to provide a better or competitive yield.
Hmm.
We are going to lower taxes.
Yeah.
The big secret and the thing that I love about permanent life insurance on the fixed side is the annual realized gains. So what that means is that if your portfolio drops 40% or the bond market dropped 20 some odd percent in 2022,
22. Yeah.
that doesn't happen inside the policy. If you have $100,000 in it and the markets drop, the next year you still have $100,000. You might have a little bit less because of the fees in the policy, but not a significant amount. And the way we design a policy is that you're actually going to get some accumulation every year.
Yeah.
And whole life is contractually obligated to increase in value every year.
Yeah.
Um, so that's a big thing for us. When we had during the COVID dip, we
Hmm.
had two sophisticated clients come to us and ask to borrow money from their policy so they could buy the dip. We
Yeah.
did not advise them to do it. They are sophisticated investors, but they had liquid cash that was available to them to buy assets at a discount. And
Hmm.
I think by now they both repaid their loans. One repaid it pretty quickly,
Hmm.
but the other one kept it going for a while. Once again, we're not going to tell our clients to do that. That's their choice.
Yeah.
But we saw during the real estate downturn, clients
Hmm.
went to their cash value life insurance in '08 to be able to have a down payment that was liquid to them. So we've seen clients pay for college when the markets were down this way
Yeah.
and let their portfolios recover. So that is a huge thing. So by reducing the volatility and giving you better returns, we have literally pushed our clients to the efficient frontier. It is
Yeah.
the definition of what asset allocators should want to do for their clients.
Yeah.
And we are adding a death benefit on top of these assets. So God forbid something happens, there is more. That's not to say clients shouldn't own term insurance. They absolutely should if they need it to protect their family. And we're also adding that long-term care benefit, you know.
Yeah.
Um, so clients really get, and they're also eliminating the management fees sometimes
Yeah.
on their assets.
Well, speaking of fees, let's talk about that because
Sure.
there's folks that are obviously RIAs and
Right.
listeners here that obviously make money off of AUM. Can
Right.
you talk about how someone who's a fiduciary, work with a product like this that is commissionable? Can you talk about how it fits into,
Sure. If
working
you
with
are a
clients?
pure RIA that will only take fees for assets under management, there's a conflict there.
Yeah.
All right. However, I can prove to you that our products outperform traditional conservative assets.
Mm,
And if you are a true fiduciary, you should be doing what is in the best interest of your clients and putting your clients in those assets. Now, these assets are commissionable. The way we are fiduciary to our clients is A, we disclose them to our clients,
hmm
and we are independent. So therefore, when we're working with a client, they will see even on a carrier to carrier basis, if we're paid differently, they actually get that number from us.
Yeah.
So if you are a fiduciary, you should be doing this for your clients. We can prove to you that it provides better outcomes.
Yeah,
But
why don't more firms didn't do it here, Keith? Is it because there is that lack of incentive? I know we say we're true fiduciaries. You got to talk about why more folks aren't getting this
I,
in
well, I
financial
think
plans?
one is a lack of education. I
Yeah,
think a lot of people think of life insurance
complexity.
solely on the basis of the death benefit.
Yeah,
And they look at the premium to the death benefit and they think it's expensive instead of fully understanding how the product works. So I think
yeah,
that's a big thing. I think two is advisors have their business model.
yep.
Their business models are based on AUM. And I'm not saying there's anything wrong with that, but they sometimes don't want to take assets away from their AUM because it impacts their revenue and it impacts the value of their business. And I also think that there's some bad insurance people out there
Yeah,
that have sold products that are completely
right.
inappropriate, that don't work properly, and advisors and RIAs have been burned.
Burn in the past. Yeah,
And that's unfortunate. Like, we want to change that perception of how life insurance is used and how it's
yeah,
structured, but there are a lot of bad players. I was just having a conversation with someone who's been in the business. So I'm in the business 21 years. He's been in the
hmm,
business 35. And his dad was in the business and his grandfather was, I think, in the business.
yeah,
And we can all tell stories of terrible players.
yeah,
Like when you work at one of those captive agencies, your number goes on the wall next to everyone else.
yeah,
And there's competition. And that creates bad outcomes for clients.
yeah,
You know, at FBO Strategies, we have no revenue goals every year. We have client acquisition goals because we feel
yeah,
that the client will eventually generate enough revenue for us, but we don't have revenue goals.
yeah,
And we're not going to say we need to generate X dollars off a client in a given year because that creates bad incentives.
yeah,
It's a hard thing to do. I've probably made less money in my career as a result, but as someone who works in a commissionable world, I need ways to prove that we do have ethics.
yeah,
And that is one of the ways we do it, is that we want to we have talked about your ROR, return on relationship.
yeah,
That is incredibly important to us. We want our clients to trust us. And we have to prove that every chance we get. And it's sometimes rare that we get to prove it, but
yeah.
we really want to prove it, you know.
No, I like it. And if we're really truly looking holistically at that client, and this does make sense and is in their best interest, I think we need to advocate for this type of solution within in a portfolio.
Yeah, and we will just, we are putting together continuing education programs for accountants. We're trying for
Yeah.
attorneys. Attorneys are a little harder because you know, we have to have a lawyer teach
Yeah.
the continuing
Continuing
education.
education. Yeah.
Right. So we are working on that, and we're also working on it for financial advisors. So,
Great.
we are on a mission to educate first. We educate our clients first, and we also want to educate other advisors as well.
I-
You know,
Is that the best way you think that we can get folks to confidently implement this? Is the education piece is
uh,
really what's
well,
missing?
I would say yes, because we want it done right. We
Yeah.
don't, we have limits on what carriers we'll work with.
Yeah.
So we don't want anybody going off to an A minus carrier or triple B carrier
Yeah.
doing this. This is or a carrier. I might get in trouble with this, but a carrier that might be, backed by private equity or something like that.
Hmm.
When you execute a Carbyne allocation, you are looking at a 20 to 50-year relationship with a carrier,
Mm. Mm.
potentially. You want to make sure that carrier is going to be in business. Now, we
Yeah.
can't guarantee it,
Guarantee.
but we have steps we take in terms of what's the ownership structure of the company.
Yeah.
The insurance industry is filled with mutual companies, which are great.
Hmm.
Mutual holding companies. There's an ESOP. I don't know if it's technically ESOP, that in fact that it's an ESOP retirement plan, but there is an employee-owned company that's great.
Yeah.
Um, Even some of the foreign companies we prefer
Hmm.
to some of the domestic companies. Uh,
Yeah.
so we want to make sure that we're doing this right every time. So it's the education, it's the understanding of what type of carriers we want to work with, and um, I don't know, like it's also one reason I'm sitting on this podcast is we need to get the word out a little.
Yeah.
And we also don't want people to abuse this. Like,
Right.
this is not a way to just make, quick money. This
Quick
is
buck.
a deep, thoughtful process that we think should be implemented throughout the industry.
Yeah. And it's part of the virtual family office model and return relationship that I advocate for is, looking, this is one piece of the virtual family office pie is that insurance component. Well, this has been great here, Keith. If anybody wants to learn more about FBO strategies or get in contact with you, what's the best way to do so?
Sure, we have a website. It's www.fbostrategies.com. FBO does stand for the benefit of. We are immensely conscious of that. You can even call my cell phone. It's 212-380-8676. And for those in the New York area, yes, I do have a 212 cell phone number, and I am never giving it up. I will it to one of my children, whichever one I like best at the end. That is a piece of real estate that will forever be passed down in my family. So we, we pride ourselves on being client focused and taking care of our clients. So we give out our cell phone number
Awesome.
to anyone who asks.
All right. We'll put all that in the show notes. Keith, thank you so much for coming on.
I really appreciate it, Rory. Thanks.
All right. Have fun.
Opinions expressed by Rory Henry on this website, podcast, interview are solely their opinions and do not reflect the opinions of Arrowroot Family Office LLC or their parent company or affiliates and may have been previously disseminated on television, radio, internet, or another medium. You should not treat any opinion expressed by anyone as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of their opinions. Past performance is not indicative of future results.